What does risk-neutral mean in finance? Have you ever wondered how investors make decisions without worrying about risk? Today, we will unpack the idea of risk neutrality in finance, especially in options trading. Risk neutral describes a viewpoint where investors do not care about risk. Instead, they focus solely on the expected returns from their investments. In this scenario, the expected return on any asset matches the risk-free rate. The risk-free rate is the return from a theoretically riskless investment, like government bonds. This concept plays a vital role in pricing options and other derivatives. It simplifies how we value these financial instruments. Instead of trying to gauge how different investors feel about risk-neutral valuation assumes everyone disregards their personal risk preferences. This allows analysts to use risk-neutral probabilities. These probabilities adjust real-world scenarios so that the expected return aligns with the risk-free rate. In practical terms, risk-neutral probability is a key component in models such as the Black-Scholes option pricing model. This model helps determine the fair price of an option by estimating the expected payoff. It does this under these adjusted probabilities and discounts it at the risk-free rate. By using this method, we can avoid the complications that come from accounting for risk premiums and individual investor behavior. This makes pricing options more straightforward and consistent. It is important to note that risk-neutral valuation does not reflect how investors behave in reality. Instead, it serves as a mathematical framework for pricing derivatives. Actual market prices do include risk premiums and the risk aversion of investors. However, these factors are layered on top of the risk-neutral base in more complex models. Understanding risk neutrality is essential for stock trading and options. It lays the groundwork for determining the theoretical fair value of options. It also helps in creating hedging strategies by replicating option payoffs with portfolios of underlying assets. By focusing on expected payoffs, traders and analysts can cut through the noise of varying risk preferences. In short, risk-neutral means treating all investors as indifferent to risk. It involves pricing assets as if their expected returns equal the risk-free rate. This assumption simplifies the valuation of options and derivatives, making it a fundamental concept in modern options trading.